Imagine this. You open your trading app, you see a perfect breakout, the candle is strong, volume is high, indicators are screaming buy. You enter the trade with confidence, and within minutes, the market snaps in the opposite direction, hits your stop loss, and then calmly goes back up without you. You feel like the market personally targeted you, but what really happened is something much deeper, a game that big investors understand far better than retail traders ever do. The truth is, markets don't move because of patterns, they move because of money. And most of that money is controlled by institutions, hedge funds, banks, and large professional traders. These players don't trade the way you do. They don't click buy and sell based on indicators. They move markets by placing massive orders that can shift price itself. Now, here's the problem. When a big institution wants to buy a large amount of an asset, they can't just press buy. If they do, price will explode upward and they'll get terrible entries. So what do they need? They need liquidity. They need people on the other side of their trades. And who provides that liquidity? Retail traders. Retail traders place stop losses in very predictable places: below support, above resistance, under the last low, over the last high. Those stop losses are not protection, they are orders waiting to be executed. To a big player, your stop loss is not safety, it is a pool of available money. So what do large investors do? They push price into those stop loss areas on purpose. They create fake breakouts, fake breakdowns, sudden spikes, sharp drops, all designed to trigger as many retail orders as possible. When your stop loss gets hit, it becomes a market order. That market order provides liquidity for the big players to enter their real positions. This is why the market often moves in a way that feels cruel. It is not random, it is engineered to hunt where the most money is sitting. Think about how retail traders are taught. They're told to buy breakouts, sell breakdowns, use tight stop losses, and follow indicators. That means millions of people are placing their orders in almost the same areas. To a big investor, that creates a map. They know exactly where the stops are likely to be. If price is near a resistance and everyone is waiting for a breakout, above that level there is a huge pile of buy orders and stop losses from sellers. Big players push price slightly above resistance, triggering all those buy orders. Retail traders think the breakout is real. They jump in. Then the big players sell into that buying pressure, offloading their positions at high prices. Price collapses, retail traders are trapped. The same thing happens at support. Price drops just below support, triggering sell stops. Retail traders panic and sell. Big players buy everything cheaply. Then price reverses upward. This is called stop hunting, but it is not illegal. It is how the market is designed to work. Liquidity has to come from somewhere, and retail traders provide it. Now, here is another painful truth. Big investors do not need to be right often. They need to be positioned correctly when the real move happens. They use retail traders to build those positions. Retail traders focus on being right on every trade. Institutions focus on collecting liquidity. While you are trying to predict direction, they are trying to create conditions where they can enter at the best possible prices. This is why news releases are so dangerous. When big news hits, volatility explodes. Retail traders jump in emotionally. Stops get wiped, positions get forced closed. That chaos creates massive liquidity. Institutions love that environment. You might think the market reacts to news. In reality, big players often use news as an excuse to move price where they already wanted to move it. When the market is quiet and slow, institutions accumulate. When the market is loud and emotional, they distribute. This is also why most retail traders lose, not because they're stupid, but because they're playing a game designed for someone else. They are reacting to price, while institutions are shaping price. Your chart indicators show you what already happened. Big investors are acting on where orders are waiting to happen. When you place a trade, you are visible, not by name, but by behavior. Your entry, your stop loss, your take profit, all of it becomes part of the liquidity pool. So, the market is not trying to be fair, it is trying to be efficient. And efficiency means transferring money from weak hands to strong hands. Retail traders trade with fear and hope. Institutions trade with patience and capital. That is the real battlefield. Once you understand this, the market stops feeling personal. Those sudden spikes, those fake breakouts, those brutal reversals, they are not the market being crazy. They are the market doing exactly what it is designed to do: move toward liquidity. And most of that liquidity is you.